My name is Philip Margulies, and welcome to Module 1 of the Basics to Investing course. I am currently a college freshman at Christopher Newport University, and in this 5-module course, my goal is to break down why you should start investing and the basics behind investing and everything you need to know, from ratios to fundamental ideas that go into your personal investing. Let's start. First off, our learning goals for this course. Our first module, this one, the basics of investing. Then, what drives the market, fundamental analysis, technical analysis, and finally, risk management. Why invest in stocks? It's simple. Do you want to grow your wealth? Do you want your money to work for you instead of you work for your money? And finally, that through diversification of funds, you can provide stable passive income for yourself. Give an example. 5 years ago, if you put $1,000 into NVIDIA, you would now have close to $30K. Let's keep on going. Where can I invest? I'm guessing you're under the age of 18. If you are, you can either use parental controlled accounts, custodial brokerages, like Fidelity, USAA, or Charles Schwab, or to gain some experience, gain some practice, hop on paper trading, hop on paper market games like MarketWatch, Investopedia, or the stock market game. Now, let's go over some key economic terms before we start this rest of the course. Interest, the cost of borrowing money on the return earned on investments. Interest is on loans and on bonds. On a loan, a bank or government loans you money, and in return, you pay back that loan plus interest. $1,000 loan, 5% interest per year, you're paying $50 a year. $5 a year on that. $50 a year, on that loan. A stock is a security representing ownership in a company, giving shareholders a claim on profits and assets. If you buy a stock or buy one share of that company, you now own part of that company. And technically, if you own enough, you can vote on that company's matters and have a controlling stake in that company if your shares are voting shares. A bond is a fixed income investment using interest, where an investor lends money to a corporation or the government in exchange for periodic interest payments and at the end, a repayment. For fractional shares are a partial share, so not a full share of a stock, but fractional shares are used to buy certain dollar amounts of a stock. For example, if I wish to buy $100 of Apple, I can buy $100 or a fractional share of that company. And a security is any financial asset that can be traded, including bonds, stocks, and options. Now, more key terms. Compound growth, the process where investment earnings generate additional earnings over time. Accelerating wealth accumulation. Compound growth is usually used when it comes to bonds or when it comes to exponentially growing your portfolio. A bull market is a market where investors have high sentiment, where prices are rising or expected to rise, and this indicates investor confidence. And a bear market is the exact opposite. The yield is the earnings generated on an investment. For example, if you put $1,000 into a stock, and that stock grows 20%, that's 20% yield or $200 of earnings that year. A portfolio is a collection of investments. If I own 30 stocks, 10 bonds, and 2 ETFs in a basket, that's 42 securities in my portfolio. And a dividend is a portion of a company's earnings paid out to its shareholders. More key terms. Liquidity is how easily an investment can turn into cash, how easily a stock can be turned into cash, a bond into cash, or anything, crypto even, into a cash. Volatility is how much risk is tied in with the security. We are going to go more in depth on volatility and how to track volatility later on in this course, but for now, it's important to know that volatility is measured by beta, which measures a stock's volatility compared to the market. The S&P is an index of the top 500 biggest publicly traded companies on the NYSE or the New York Stock Exchange, or one of the 2 major stock exchanges in America. Asset classes are groups of similar investments, stocks, commodities, just oil or vegetables or soybeans even, bonds and currencies. These can also be traded, but those are more commodities, and currency trading is a more complex form of analysis. Maturity date, when a bond, option, or derivative expires, and sectors are how a market is split up. For example, technology, construction, or other industries. More key terms. A stock ticker is a stock's unique symbol. For example, Apple is AAPL. Opening price, 9:30 a.m., where the stock opens, and closing price is when it closes at 4 p.m. every single weekday. Moving averages is a trend indicator that smooths price data over time and shows the stock's trend, up or down. And a volume is the total number of shares traded in a given period. And it's important to note that when a stock is going one direction or the other and is trading at an abnormally high volume, that is a good indication that that stock is being overbought, oversold, or experiencing a rush. Beta, we've already mentioned, an IPO is a company's first public sale of a stock. That means the first time the stock was on the market. And the blue chip stocks are large, stable companies seen as industry leaders. Now, what are stocks? Stocks are a unit of ownership in a company. Companies issue stocks so they can raise money for their own projects. Think of it this way. Let's say that you open a toy store. It's growing, it's profitable, you're making a lot of money, and you want to expand your business. But you don't have the money right now to fund it by yourself or to keep your company private. In that case, you would send your company public, have an IPO, and raise money through shareholders who buy money to buy part of your company and experience some of your profits. And with that money, you would reinvest it back into your company instead of paying dividends and growing your company as a whole. Growth stocks reinvest, just that example, into the company, while dividend stocks pay out a portion of earnings to shareholders as dividends. These stocks do that because the company is usually stable and growing at a decent pace. Stock prices are based off the law of supply and demand, company performance, market conditions, and investor sentiment. We will have a whole next unit going into market sentiment. And stocks can be classified into two types: common stocks, voting rights, or preferred stocks, which pay dividends but do not have voting rights. However, preferred stocks usually are bought out first in the case of solvency, or in stock buybacks, where a company buys back their stocks. And the stock market, as I've already said, is an auction where buyers and sellers negotiate prices. And stocks are bought and sold on stock exchanges, like the NASDAQ, which is mostly tech stocks, or the NYSE, which is a major market, which is also can be traded as an ETF. And both are open, as you can see. The NYSE is a physical location on Wall Street. Meanwhile, the NASDAQ is a virtual auction. The NYSE is an auction market where there is no middleman. However, in the NASDAQ, it's a dealer market where buyers and sellers operate through banks or firms or brokerages who take cuts. All these cuts are minimal. And the NYSE holds traditional blue chip stocks and is less volatile than the NASDAQ. Now, what is the difference between a stock, a bond, and an ETF, and which one should I invest in for which reason? Stocks, higher growth, more risk. Bonds, more stable, fixed returns. ETFs combine both. ETFs is basically taking your apples, which are stocks, your grapes, which are bonds, and putting them together. Just combining the two and creating diversified, lower cost exposure to various assets. And ETFs can be traded. It is important to note that ETF bonds do not have maturity dates. Now the basics. In the next few slides, we're going to go into different kinds of investing. But first, let's go over the basics. First off, pick your strategy and stick to it. Start small. Even $5 a week adds up. Don't rush in and throw all of your available funds into investing off the start. Invest in what you know. Don't buy into hype without really paying attention to what the hype is. Because a lot of times, the hype is misjudged or misguided. Think long term. Don't panic and don't sit yourself and constantly stare at your screen and watch how a stock is performing. Don't panic. Daily changes are fine. And set goals. A quote that I learned is do everything with the end goal in mind. Have a goal, set your goal, and invest to reach that goal. And of course, diversify. Now, let's go into different types of strategies. First off, the buy and hold, then day swing trading, income investor or dividend, value investor, and the dollar cost averager. Buy and hold. What is it? Buy and hold investors purchase stocks and hold them for years. They disregard short-term market fluctuations and focus solely on the long-term benefits and long-term valuation of said stock. Why it works? Stock market grows over time. The S&P has grown 10% per year since 1957 on average. Because of that, stocks grow, and over time, your portfolio is going to grow just by leaving high-value fundamental stocks in there. Buy and hold investors focus on stability, they ignore short-term market noise, and they look for high asset class companies that are well established. An example of this is Warren Buffett, with Coca-Cola, Apple, Microsoft, and other investments that has turned Berkshire Hathaway as one of the biggest funds in the world. Now we have swing or day trading. This involves buying and selling stocks within a single day of trading or within a few weeks. This works because traders try to use technical or fundamental analysis and indicators to profit off short-term price movements. An example of this could be after the election, after Trump won the election, where Tesla stock jumped $80 or about 33% in the course of 3 days, just because of Elon Musk's involvement with the election. Day swing traders anticipate stock reactions to breaking news and buy a lot of stocks or short a stock or buy options, calls or puts, in order to take advantage and capitalize on that movement. And to be a good swing trader, you must have constant time to manage and monitor markets. You must have an extreme knowledge in technical analysis and be willing to lose a lot of money very fast. Income dividend investors are investors who focus on stocks that pay dividends over time. These stocks are consistent, have growing dividends, and maybe don't have the flashiest returns, the best earnings calendars, or the best upside potential, but these stocks are stocks that pay off steady dividend reinvestment plans and are suitable for conservative investors looking to build passive income over time. For example, Apple pays pretty high dividends. You can earn $5,000 a month of putting about 6-7 figures into Apple stock. The most major ones that are known for their yearly recurring dividends are Coca-Cola, Johnson & Johnson, and AT&T. Now, value investing, my personal favorite, one that I will stress more upon, is an investor who buys undervalued stocks below their intrinsic or their real, what their value should be, aiming for long-term gains. This is like finding a diamond in the rough. I'll give an example. Tom Brady was drafted in the 5th or 6th round of his draft, right? He was the 4th draft pick, 4th quarterback on the Patriots depth chart at the start. But Bill Belichick, or an investor, saw something in him. He saw whether it be a great PE ratio, a great future potential, a great leadership, amazing cash flow, amazing equity, amazing returns, great debt to equity ratio, great leadership, great profitability, great skills, and bought that asset well below its intrinsic value and kept it long term and watched it blossom into a superstar. Value investors use thorough research into a company's financial details, the leadership, in all aspects, whether it be fundamental or technical, and use those classifications and research to identify a stock they believe is undervalued and should be invested and held throughout time. Value investing is the best way to make a lot of money over time and is safe. I recommend it. Now we have the dollar cost averager. This is an investor, usually best for beginning investors, to minimize their risks. They will pick a stock and decide on an amount every single month to invest into that stock, whether it be $1,000, $100 a month. No matter what, they put that money into a stock. So let's say a stock is $10 a share, and you buy 10 shares, $100. That stock in the next month rises to $20 a share. You buy 5 more shares. Now you own 15 shares at $300 market value, right? Now the next month, if that stock price dips down to $5, you buy $100 again. That's 20 shares. You now own 50 shares at another price. And if the stock prices rises again, you gain more money in value and buy $100 more of the share. Therefore, you smooth out your average cost, you lower your average purchase price, and you minimize risks, and over time, you're going to make money as the market goes up. Dollar cost averaging should be used in conjunction with value investing and dividend investing to find a way to grow passive income. Now let's look at the benefits, the pros and cons between index funds or ETFs or individual stock price pitching and picking. If you're picking stocks by yourself, if you succeed, you're going to have larger returns than index funds. You have complete control and the ability to operate off your own personal investing style, and you can buy what you want, sell when you want. But however, there's higher risk. You also lack widespread diversification by investing by yourself. Unless you're investing millions and millions and millions, you're not going to have enough money to properly diversify. And it requires high level of understanding to do this. Now, for ETFs and index funds, you can allow for passive investing. You can trust confident returns. And when markets rise, index funds do better than active management. Because over time, a fund is more diversified in many different sectors. And as each sector grows, all the stocks are bound to grow. And diversification, hedging bets, minimizing risk and volatility. And also, if you wish to invest in, let's say, solely the emerging tech sector, you can target sector-based index funds. Cons, bad stocks, shut down the fund. You can't pick and choose which stocks to invest in more in these funds. For example, if they have NVIDIA, a big winner or a big loser in that fund, you can't pick to not buy that loser. It's all part of the fund. And during market downturns, picking stocks yourself works better. And fund fees kind of suck. Now, some resources I recommend to use as you continue your studies are TradingView for graphing, Yahoo Finance, and Investopedia. Thanks, and off to the next module.